Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. We saw earnings last week from one of the largest, most dynamic companies on the planet, a business which for the third quarter in a row generated revenues above $100 billion, earning almost $3 per share more than analyst expectations, and yet the shares of Amazon fell by more than 7% after those numbers. Why? Well, the firm's revenues grew at just 27% year over year, a significant slowdown when compared to Q2 2020, when revenues jumped by 41%. Never mind the fact that the company forecasts revenues or sales of between $106 and $112 billion for Q3 2021. The market was looking for $119.2 billion. And that is where the problem lies, because Amazon is a business like few others, with turnover that is the envy of almost every other firm on the planet. That's not enough for a market that always wants more, where expectations are hyped up and stocks are priced for perfection. From a stock market perspective, that's a problem for Amazon investors right now. But from the standpoint of the global economy and environment, it's a potential problem for all of us. Because perpetual growth and sustainability may be incompatible in many areas of the economy. Amazon has committed to becoming carbon neutral and is hoping to run its operations entirely on clean energy by 2025. Yet the resources consumed by a business that employs 1.33 million people worldwide and which dispatched 3.5 billion packages in 2019 are enormous. Of course, big parts of Amazon's business empire, such as web services, exist purely online, and energy aside, they are less resource intensive and therefore are potentially more sustainable, even as they grow. Sooner or later, however, investors are going to have to decide what they want to prioritize most between investment returns and sustainability. That could create an unformattable choice not just for individual investors, but for institutions too. For example, many state pension schemes are underfunded and have future commitments that they may struggle to meet if we move into a period or era of lower growth and lower investment returns. After all, 10-year U.S. government bonds are yielding or returning just 1.23% per annum currently. However, when we take inflation into account, the real return drops in negative territory, effectively meaning that investors are losing rather than making money out of their treasury bond holdings. It's not just the returns on government bonds that have been suffering. U.S. corporate bonds also have the lowest real yields since 1980, according to Bank of America. Against that backdrop, pension funds, life insurance business, and fund managers are having to look elsewhere for their returns. Hence the growth in both the scale and popularity of private equity and venture capital funds, which have bankrolled the technology startup scenes in Silicon Valley, London, and Asia. Such is the demand for private equity that Carlyle Group is planning to launch a new fund and aims to raise a record $27 billion as it does so. The growth of private equity and venture capital funds has led to the emergence of hundreds of so-called unicorns, startups that are funded to the tune of or valued at $1 billion or more. The vast majority of these unicorns are growth companies, businesses that are focused on gathering market share and not profitability, and these firms are usually loss-making. The private equity and venture capital funds and their institutional backers, who have billions of dollars invested in these startups, can really only make money or realize the value of their investments in one of two ways. They can make a trade sale, selling the business to another venture capital or private equity firm or a competitor in the same industry, or they can IPO their unicorns. That means turning a private company into a public one and selling shares in that business to stock market investors. However, this has meant filling up the stock market with growth companies, which initially at least are not profitable, and as with Amazon, often end up being victims of their own success by becoming priced for perfection too. Up until now, that hasn't been too much of a problem, as research from Bank of America showed this week. Central bank quantitative easing, or asset purchases made with freshly printed money, have provided support for the share prices of technology stocks since 2009. And as this chart shows, it accelerated their share price performance over the last 18 months. The profitability of private equity and venture capital investors relies on their ability to persuade stock market investors to buy their unicorns, and to do so at valuations that are far higher than the VCs invested at. To accomplish that, they and their advisors need to sell stock market investors a growth story about the future potential of that unicorn investment. But, of course, the higher the exit multiple achieved, then the harder it is for the underlying business to live up to that potential. Stock markets are now perhaps becoming more discerning in this regard, as we saw with the recent IPO of a poster boy of venture capital-backed unicorns, Robinhood, which had one of the worst day-one performances for an IPO of its size, $32 billion, with the stock falling as much as 12% below its listing price on day one. The lesson in all of this for retail investors is to always think about why you are buying a growth stock. Why are you paying more for it than the previous owners did? And how easy or otherwise will it be for the underlying business to deliver on growth targets that justify its current share price? If you don't like the answers to those questions, then maybe you shouldn't be buying it at those prices. That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.